We finished forecasting the financial statements and valuing Tesco. We will now discuss some other issues that may arise when forecasting. Firstly, you need to consider non-financial operating drivers. We've used financial drivers to forecast the financial statements of Tesco. We forecast sales revenue by estimating the growth rate, and we forecast all other financial statement lines by either directly or indirectly assuming that they were driven by sales revenue. But you should consider whether non-financial drivers are more appropriate and more accurately estimate the financial statements for the particular company that you're valuing. For example, in industries where prices or technologies are changing dramatically, your forecast should incorporate operating drivers such as volume and productivity. Secondly, you should consider cost behavior, whether the costs that are being forecast are fixed or variable. At the company level, this is typically unimportant because most costs are variable. But this may not be the case at a more granular level. For example, for individual production facilities or retail stores, most costs are fixed. Thirdly, you should consider inflation. Usually the cost of capital that we use to discount the free cash flows is estimated in nominal rather than real terms. If this is the case, your forecast cash flows also need to be in nominal terms. Don't adjust them for inflation. However, you need to be careful if high inflation exists. High inflation will distort historical analyses. Finally, you need to think carefully about the type of perpetuity that you use to calculate the continuing value component. We will talk about this more next. In our Tesco model, we used a simple growth perpetuity to estimate the continuing value. In the Valuation Summary tab, we calculated the continuing value for the free cash flow to the firm model in this cell. Contained within this cell is a simple growth perpetuity equation, which estimates the continuing value by dividing the base year free cash flow at the end of the forecast period by the WACC less the growth rate. Bear in mind, a variety of different types of perpetuity equation exist. We will briefly discuss an alternative equation in a moment. There are many misconceptions about continuing value. A large continuing value does not necessarily imply aggressive assumptions are being made about the firm's long-term performance. In addition, the most common error associated with continuing value is naive base year extrapolation. Always check the base year cash flow is estimated consistently with long-term projections about the company's growth. We will briefly look at some common errors made when estimating continuing value. The continuing value can be highly sensitive to changes in its parameters. If you change the base year free cash flow, which remember has the existing return on invested capital embedded within it, or you change the return on new invested capital, or the growth rate, or your estimate of the WACC, it will have a significant impact on the continuing value estimate. So you need to be very careful when considering your estimates for each one of these parameters. We will now run through some common pitfalls with estimating continuing value. When estimating the growth rate, look at revenue growth for the industry and consider any company-specific factors that you may have identified during your analysis of the company's strategy. The growth rate used in your continuing value estimate typically should not exceed the overall growth rate of the economy in which the firm operates by more than 1 or 2%. For multinationals that operate across multiple economies, the growth rate typically should not exceed the growth rate in the global economy by more than a couple of percent. In forecasting the base year free cash flow, assuming the reinvestment rate is constant may not be appropriate. This implies NOPAT, investment, and free cash flow all grow at the same rate. Another common pitfall is naive over conservatism. The most common example of this is the simplifying assumption that the return on new invested capital equals the WACC. This can be a faulty assumption. For example, strong brands, plants, and certain types of human capital allow companies to continue to generate economic profits for sustained periods of time. This is a case for pharmaceutical, consumer products, and some software companies. Another pitfall is purposeful over conservatism. Many analysts err on the side of caution when estimating continuing value. This is because of its size and uncertainty. But to arrive at an unbiased estimate of value, you should use the best estimate available, not necessarily the most prudent one. Remember, the risk of uncertainty is already captured in the WACC. An alternative to revising estimates downward to be prudent is to model uncertainty with alternative scenarios and examine the impact on the valuation. There are many alternative approaches to calculating the continuing value. For example, the key value driver formula, the economic profit model, liquidation value and replacement cost, or using exit multiples such as price earnings and economic value to EBITDA. We will now focus on one of these approaches, the key value driver formula. The advantage of this model is it explicitly ties cash flow to return on invested capital and growth.